Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A very warm welcome to our GFM clients and guests who are joining us for this morning's webinar, which is an update on one of our very favourite funds, the Ellsteron JAADE Private Assets Fund. We're absolutely delighted to have David Leslie, co-portfolio manager of the Ellsteron JAADE Private Assets Fund, joining us. David's well known to our clients, having participated in these webinars in the past. I'll officially introduce David in a moment. Broadly speaking, it's been a really good period to be an investor in 2021, with all the major asset classes producing strong returns. But as always, markets are eventful, and the forward-looking economic environment appears a little more challenging, particularly with the unwinding of the massive fiscal stimulus that was injected into the system during the COVID environment. After a very strong return period, valuations do look a little more challenging. We suspect investors are going to be far more discerning about their entry point into markets in 2022. As a firm, we've long been appealed to private equity/private asset investing. At the core of our philosophy is that private companies offer significant valuation opportunities relative to their listed peers, but also provide investors an opportunity to diversify their return opportunity. That said, private asset investing is not for the faint-hearted, and it requires professional expertise and a high degree of skill. Unfortunately, many of these earlier stage businesses don't realise their real potential. So I can't wait to discuss with David his views on private asset investing and talk about how the fund is positioned. Now, before I get underway, I have the obligatory disclaimer to make, and that disclaimer is that this morning's webinar is general in nature and not personal advice. Should you be seeking specific advice or more detailed information on the Ellsteron JAADE Private Assets Fund or on your personal situation, please don't hesitate to contact our office, and one of our advisors will be more than happy to assist. So please allow me to formally introduce David Leslie, who is the co-portfolio manager of Ellsteron JAADE. David joined Ellsteron in 2005 and has over 23 years experience in technology and investment markets as a researcher, analyst and investor. Most recently, David has been an investment director for the Ellsteron Ventures Fund and the Ellsteron JAADE Private Assets Fund. In this role, David leads the investment process, due diligence and negotiation with investees, as well as reporting to investors. David is also the non-executive director of two of the companies in the JAADE portfolio, Mabel and Prospection. Good morning, David, and welcome.
Thanks, Paul. Thanks for taking the time to have a chat today.
Thanks, David. David, let me start. I gave a little bit of introduction into private asset investing and why GFM is appealed to this area, but do you just mind spending a couple of minutes as to how you define private asset investing?
Okay. So private assets includes everything from infrastructure to property, to traditional sort of leveraged PE, the KKRs of the world. And, you've also got at the very early stage of private companies, you've got venture capital investing, angel investing, all sorts of early stages. So private capital investing, private markets are basically markets that are not listed, they don't trade. So there's no sort of day-to-day volatility. So what's important about that is what managers are trying to do is to improve the businesses over time. So you don't have the day-to-day ups and downs of the market, but rather you're working to a plan, in our case, over 3, 4, 5 years, to try to drive the growth of the business and the value of the business. And during that journey, hopefully you're buying well at a wholesale price, operating and working with the managers in the business to achieve, outcomes. And then you're able to then time your exit around market conditions to hopefully then get, a re-rating. So you don't just get the benefit of the underlying growth of a company, but hopefully you're improving the valuation metrics, the multiple of earnings or sales that ultimately you can exit and realize at. But I think in private assets, one of the greatest advantages, if not the single most important part for us, is really that private companies, so we can sit on boards and we're insiders in the business. So we're actually sitting there side by side with management and helping them on their business to achieve their desired outcomes for their companies.
Well, that's a great segue for my next question, David. So I'm keen to learn a little bit more about the Ellsteron JAADE team, and it seems like you're quite actively involved. Can you talk me through that process of how you're engaging and working with these companies?
Yeah, it's been an evolution over sort of 10 years. When the team first started out, it was Anthony and I, and Anthony had been a senior executive at PBL, where he'd sat on the boards of Seek and Car Sales as private companies. And we really launched our private investment business back in sort of 2010. What we worked out over time is we were probably at that stage engaged with investments around $2, $3, $5 million per company. And then Jamie and Tony Casanos, who had been a part of the turnaround of Aristocrat from being $1 billion company to being a $15 billion company at the time, it's now much larger. They sort of said to Anthony and I, this is great, but we don't want to do early stage companies. We think that this is a much more scalable opportunity. So we've really built out a team around people who've got hands-on experience running businesses, such as Jamie, Tony, and Anthony. We've also built out an investment team who are helping us to do all that sort of background work, due diligence. Remember, we're only doing 2 or 3 deals a year, so that means lots of due diligence, incredibly intense processes about making investment decisions. And then further to that, we have a broader group of advisors who are people who are not only investors in our fund, but they've got their own experience. Peter running News Corp in Australia, Nasima in the marketing industry. You got Carl, who runs an online retail business, Michael Malone, the founder of INET, and Matt Rockman, one of the Seek founders. These are people that we call on to get advice, and where required, we can use them to work through specific issues with the company. So when we're sitting there pitching to a business to take our capital, it's partly about the valuation, the structure of the financial solution, but a lot of it might be around the value adds that we can bring from our operating partners and maybe it's about building out a US market entry strategy. Maybe it's about how they get the maximum value of an IPO or a trade sale. All things that we're very familiar and comfortable with.
So I can see a high level of due diligence and an expansive team that you've got there, David, in the selection process of identifying companies you invest. Once you do invest in those companies, what's your role then with the companies?
Okay. So what we're trying to invest in are the best private companies in Australia that are technology-based Australian companies. So just to be really clear for everyone online, we're not competing against going to Silicon Valley to compete with, US VCs. We're not competing in China or Europe. We're looking for great Australian private companies. We're looking for the companies that have a similar alignment around working with us for the next 3 to 5 years to try to maximize the value for them as the founders and management, but also as shareholders. And so, it's really important that when we do our due diligence, it's a lot about the business and the numbers, but it's can we work with these people? Will they listen to us? So if you look at the founders that we work with, you'll find that they're probably at the more mature end. They maybe have 20 or 30 years of business experience, and often they've built their businesses up, over 5, 10, 15 years. And so if we were to go through the portfolio companies, you'd see the pattern is people who've got to a point where their business needs some capital, but it also needs that little bit of advice to think bigger, to execute on a greater scale, and to really scale their businesses to go from maybe $50 to $500 million of growth. So a lot of what we do is we talk to them, do they have the systems in place, the people in place, the capabilities and the vision to be able to grow to large companies? Because over a 3 to 5 year journey, a business might double and then double again. But if we're looking for who the next owner of the business is going to be, it has to have the potential to keep growing at material rates in order for us to capture these high multiples that we're looking for. So it's board meetings, it's working with management in focused areas, it's governance, it's all of those things that enable companies to go from private ownership to the next stage of life and really scaling up.
So just to drill down into that philosophy a little bit more of JAADE, David, obviously there's a focus here on focusing on companies through a technology lens. Why is that the key focus of the fund?
Okay. One of the really interesting things about technology is I've been in technology markets since 2000. My first job out of uni was working for an IT outsourcing business, EDS. Right? Large traditional IT businesses. The role of technology in my 20 odd years of working has accelerated like never seen before in the last couple of years. So us doing this webinar right now, then checking our bank accounts online, I was with my mum on her 80th birthday on the weekend, and I showed her how to use WhatsApp finally. So she's got a, Apple iPhone. It's whatever age, my children, my wife and I, everyone we deal with, Increasingly, you're using technology in ways you never thought you would. And also, the number of people working in the industry has never been accelerated. The demand for technology people reflects how it's shifting the overall economy. Now, despite that, Paul, if you look at the Australian market, around about 4% of the ASX is in technology companies. Now, old-fashioned Europe, and maybe that number's 5% after you have, and this includes an Afterpay of the world, right? This is with some of the massive success stories. But we're still resources and banking focused economy and traditional industrials. As you go to the rest of the world, you get to the US, which is at least 30%, right? And we all know that the US has been fantastic at driving innovation growth. Now, why is that bit really important, Paul? Because if you look at the current economy, according to Goldman Sachs, you've got industries which are under maximum pressure, whether it's real estate or utilities. You've got other areas, the traditional growth sectors, such as healthcare. But technology is fundamentally the fastest growing part of the ASX market. So through the eyes of the sectors that we can get exposure to, you've got the highest growth rates. What we're bringing by investing in private companies is businesses at a slightly earlier stage, probably with more innovative and disruptive models, and they're getting their first licks of significant institutional capital that really fuels their growth. So our portfolio companies are growing at a really strong 50%. So if you think about the kind of why technology, it's because we see almost unlimited growth and we see some great opportunities to invest in these great technology businesses. Now, many of these will never see the ASX. Many of these will be bought and sold in private markets that are getting deeper and more liquid every day with US investors, global strategics. We see strategic interest in our assets very regularly. And so to capture this growth, we really believe, and having come from managing our listed equity portfolios at Ellsteron, I see so many more exciting opportunities in unlisted companies than my colleagues running the listed portfolios.
So the propositions sound, David, and we know how much work the JAADE team puts into these businesses at an operating level. I guess the golden question is the JAADE team now able to demonstrate the value add in this area?
So there's a couple of slides here that we use these slides actually when we're talking to potential portfolio companies. So when we're in pitching to our next target, we try to explain that, often you find that there's founders who are they've built up really nice businesses over time that are growing at some decent growth rates, but they're always looking to fund their lifestyle out of their business and they don't have the risk appetite to accelerate. So what we show these companies is our track record with a couple of companies, IntelliDocs and CAMS. These are businesses that from the moment that we invested, put more capital to work and also sat around the boardroom table and really gave management the license to invest in sales and marketing, drive growth, because we're always looking for businesses that have established products. So we know that when we go into them, we're adding fuel to the sales, marketing, and the scaling up of a company. And so what we can illustrate is that the growth rates from when we invest in companies dramatically accelerate from good private company numbers of about 20% to accelerating up over 50% per annum. This is pretty much the sweet spot for us, are these founder-led companies. Hopefully these days they're a bit bigger than the sort of $6 or $7 million of revenue. But it's about sitting with them at the board, making sure that capital's going in the right areas, and sometimes saying to the founder, you got to get out of the details of running the day-to-day side of the business, and you've got to think more strategically about what's actually going to move the needle. If you're going to go to the US, you can't fly over there and make sales doing a 3-week trip around the US. You've got to have people on the ground there. Another example, Paul, is probably our favorite company, which is Mabel. Many of your investors may be familiar with that. With Mabel, we've sort of had a slightly different journey because that was a venture capital investment we did in our predecessor fund. And what we've seen with Mabel is the compounding of the growth rate over a long period of time. And what we've been able to do in the case of Mabel is add some fuel to that sales, marketing, and product side of the business. But also having board representation, I think, has been really important because Mabel's a business about putting people into people's homes to provide home care services. So from the very early days of our involvement, given that we're a fiduciary representing our investors and clients and a broader Ellsteron business, we made sure that this little company was very aware of the risks of what they were doing, was proactively bringing people into the business who had clinical care experience, And so we could deal with the complexities of having people go into their homes where accidents happen, and there would be, medication was maybe poorly administrated, there would be issues and incidents. And so just that layer of governance in these high growth businesses can sometimes be the key to their sustainable success.
Yeah, fascinating. Before we get a little bit more forensic about the JAADE portfolio, I'm really curious as to the mindset of the founders of these businesses, and at the point that you're an investor, David, and they sell down. I guess there's a couple of obvious questions here. Firstly, is the founder checking out, so to speak? And secondly, how difficult is it, or how easy is it to get an alignment of interests at that point?
Yeah, it's an interesting question. So as we sort of touched on, we shy away from businesses where there's a 28-year-old founder who's, thinks their business with, $10 million of revenue is worth hundreds of millions of dollars. And, they plan to list on the NASDAQ.
Yep.
That's a very quick conversation for us. It's like, you got a fantastic business, but, we're a bit more measured than that. And, we're going to miss out on lots of incredible businesses. There's so many wonderful companies out there, but we're looking for that real alignment of interest that you touch on. So in the case of some of the opportunities that we've invested in recently, there's one scenario where you've got focus, where a business has been going for about 15 years. The founding group is probably running out of a bit of puff, right? To be very clear. And they've had some other shareholders who had bought some shares in the company who wanted to accelerate growth. We had a meeting of minds with them. One, the co-CEO model, which had two founders, we decided to streamline it and go with the founder who had more ambition, more energy, and a greater vision for turning it into a much larger company. Two, we provided the capital that meant that some of those people who were stuck in the business that probably needed to be shifted aside could take a little bit of money off the table and allow the rest of the company to move forward with a higher risk appetite to drive growth. And then three, what we often do is then, for the people we believe that they need to bring into the business, as well as some of the key executives in the business, we then design share plans that mean that they're aligned, whether it's options or share grants. We then work on structures that might be worth as much as 10% of the value of the company, that say, from where we are today to get to where we want to go, those people who drive the growth, along with us as the incoming shareholders, can participate together and have that absolute clarity on alignment and an ultimate exit or realization of it.
And when you first invest in these companies, David, a question of curiosity, do you have to be very defined about the likely holding period in that business, or how long you see yourself co-partnering with the business?
Yeah, there's many conversations that go around it. In some situations, we will enshrine it within the shareholders' agreement that they must do it by a certain date. Mostly because we're investing in businesses, frankly, that have a lot of choices. When you see a lot of these pre-IPO investments, I think they're very clever structures for companies to raise money and have a commitment to get to an IPO. And what we find is the best companies don't want the obligation to have to do an IPO in 6 or 12 or 18 months, because frankly, that might work well for the investor, but the best thing for the business might be to wait another 2 or 3 years while their business continues to grow. So we try not to be too prescriptive in exactly when it happens. We've designed a fund that allows us flexibility. It's not a closed-end fund, so we don't have to wind up and return everyone's money in 3 years' time. We've built an alignment between the structure of our fund and just making sure we can get the best outcomes for the business. But we do have lots of conversations around this 3 to 5 year expectation, and make sure there are processes around having reviews, having the right to call in an advisor. But, good companies will know that there's, and they always say, yes, lots change in the first couple of years, markets are going to change, but there is a fundamental, they've got employees who also want to realize the value of their equity. So we make sure there's real clarity, alignment between management, alignment between the founders and the shareholders in those companies when we go in.
Yeah, terrific, David. Okay, so the fund's been going a bit over 2 years now, 2 years and 2 months.
Yep.
I'm really keen to see how you've got the fund position right now.
Okay. So when we started the fund, we always had an expectation that after 2 years, we'd like to get to about $200 million. And we'd like to be on our way to sort of having, maybe 5 or 6 investment portfolio companies. Things have gone very well. It's been a very good environment for private investing. We've been, I guess, supported by some good groups and investors who've provided us capital, and the number of opportunities has been very strong. We're now at a stage just over 2 years into the fund that we've got 7 portfolio companies. We've got a strong cash position in the fund as well, and we've already had 2 realizations. So probably the bit that's happened a little bit quicker than what we might have expected was the IPO of Tyro in the first instance, and now the successful IPO of SiteMinder. And you can see here from the portfolio allocation, our largest positions, SiteMinder, which we can talk about a little bit. CAMS is, we touched on earlier, is an Adelaide-based enterprise software company that Joe's a 63-year-old founder who brought in a CEO. That business is performing well. Mabel, the home care business that's got an exceptionally strong run rate. They've recently received an investment from General Atlantic, which we can touch on. And then we've got 4 other, these are our sort of newer portfolio companies that hopefully become as large a material as the existing ones, Prospection, As You Pay, Focus, and Prospector. And, and with that net cash holding, that's as we're sort of going through the IPO process around SiteMinder, we're taking some shares off the table, replenishing our cash resources, and we're in very good shape to make another investment in the next few months. In fact, as we talk about the pipeline, there's a bit of progress in that area.
Terrific. Now, I'm curious just to drill in on something. You said that you've already, probably a little bit ahead of expectation, had 2 realisation events. David, can you just explain how you define a realisation event?
Okay, so realisation event will be one of 2 things, an IPO or a trade sale. Yep. In a trade sale, generally you get your money up front, you get paid a takeover premium for control. There might be an earn-out, so you then might continue to hold some residual investment in the company for another 6-12 months. In an IPO, like SiteMinder, you have the event, the company's listed. We're not subject to any escrow. So in the case of SiteMinder, we're free to trade the stock. We've decided to sell a few shares because it's gone through $7 on sort of day one. But we're continuing to hold on to the balance of our shares, and we see an opportunity to realize even higher valuations over the coming 12 or 18 months. So in the case of SiteMinder, it's a partial realization. In the case of Tyro, after it listed, we then sold all of our shares and redeployed them in those new investment opportunities.
Okay, well, I wouldn't mind focusing on a couple of them. We're not going to get through all of the companies, David, in the time allotted, but I'm keen to talk about a few of the companies so our clients have got a real understanding of the flavour of the companies that are in the fund. Do you mind if we start on Mabel? You've already given a little brief introduction as to Mabel, but yeah, if you could talk about the journey with Mabel and where they're at right now, that'd be terrific.
Okay, so Mabel, in a nutshell, is a home care marketplace supporting families and individuals, typically with NDIS, so disability funding, or aged home care packages. Now, both of these markets in recent years have had enormous shifts. The government's changed the model of funding, and rather than giving it to the institutions that have traditionally provided care, they're providing the funding directly to the individuals themselves, who can then direct how that money is spent to provide them with personalised services that meet their own individual needs. And so where Mabel's jumped into the market is they've taken a marketplace model. So, maybe like an Uber for a second. On one side of the marketplace, you've got the people who are looking for care, the consumers, and then you've got the carers on the other side, who are independent contractors that might be providing casual home care services to someone, that's aging, maybe with dementia, who has a $40,000 home care package, helping them with meal preparation, general household duties. It may be, a bit more hands-on in terms of, showering or personal support, and even administering some drugs. There are allied healthcare professionals on there doing, a range of services from physio to other areas of care, and then you might have nurses on there with various certificates as well. Now, the biggest segment of Mabel's market is actually the NDIS. It's about 60% of the company's revenue. Within that, it's children with autism. And so a lot of the big, strong relationships are families that are looking for support for their autistic children. And as they sort of grow up to want to live independent lives, then wanting ongoing support, maybe they're living in independent sort of living situations. Now, why that's really important plays out in this chart here. The different colors represent a monthly cohort of clients. So if we come back here can you see the mouse there?
Absolutely.
Yep. So if you look at sort of around this period around May 19, and you take that sort of pink area, that represents the dollar value of the clients who joined the platform around about April 2019. And so up here, you've got the monthly value of delivered care. So the company's currently running at about $16 million a month. So around about $200 million of annualized care. You can see, a couple of years ago, this is a business that wasn't even doing $1 million a month. So it's been a phenomenal journey. The reason it's been able to achieve that is if you take those clients and you follow them on the journey, 2 years later, more than 2 years later, those clients are still spending money on the platform. So once you build a relationship with the clients on your platform and the workers, and maybe you replace the workers because their situations change, or maybe the needs of the clients change. But you've got them on the platform. The platform does, screens them, vets them, checks their qualifications, then arranges for the bookings. Now, between the worker and the client, they then set their own rates. And as long as they fall above minimum payment levels, then Mabel facilitates the timesheets, the payments, the payment processing, which is an important part of then accessing the funding from the federal government. And so these long-term relationships, and there's also another element, which is insurance. So one of the incentives for the workers and families to stay on the platform is if they go off, they lose insurance. And there are inevitably things that go wrong. There are accidents, and the workers, obviously, if they're doing lifts and whatnot, it's important that they have, some level of protection in providing these services. Now, the stickiness of these clients means every month, as we continue to add larger and larger cohorts of clients, it's been fueling the growth. And you can see here that through the recent lockdown, which has kind of been a pain for all of us, the business had flatlined. Now, in lockdown number 1, it had a dip, and then it roared back very, very quickly, right? So what we're starting to see in the business now, and if you were to look at the sort of the November data, the business has started to re-accelerate. Now, will it have a spike as strong as this? Time will tell, but there are some encouraging signs.
So, David, you spoke about realisation events before, and I couldn't help noticing on the slide here that only a couple of months ago that that Mabel received a very large equity investment into the business. Yep. So, firstly, I guess my first question is, why is this not a realisation event for you, General Atlantic investing 100 million? And secondly, my understanding is General Atlantic is a very, very, very big private equity fund. What interest have they got in an Australian business like this?
Yeah, it's so General Atlantic's about an $80 billion fund based out of the US. One of the reasons in particular in Mabel's case, there's a real connection with them, is their background. The founder of their business was a gentleman who sold duty-free shopping stores, sold it for a few $1 billion. And then he basically gave the money to some investors and said, I want you to back entrepreneurs, support their businesses, and then I want you to grow the capital as much as you can, and then I want to give it all away. So the founder of General Atlantic was an incredibly philanthropic individual, and he's now given away 99.5% of all of the value that was created in the last 20 years. And so the investors in his funds are people that share similar values. So the Warren Buffetts of the world, these famous sort of philanthropic investors. So why that's important for Mabel, given that Mabel is about supporting people in the care industry, bringing on an investor that is seen as having an alignment of values around wanting to provide care. And Mabel's a business that is all about for purpose and for profit. So there's an equal alignment around wanting to do the right things by their clients in the disability and aged care sectors. So why did they get involved? One, I think they saw the alignment of the values, but two, they're experts in investing in these marketplace businesses, and healthcare is a particular area of interest. The team from General Atlantic that drove the transactions actually based out of India. And in India, they've been making a large number of very significant investments around healthcare, around retail and other areas. And they've been looking at Australia for some time. They have Australians in their team in Singapore. And they've been scouring the market, and I guess they were waiting for the right situation where there was an alignment of interest. Now, why isn't that a realisation event? The investment they did provided $30 million of funding to the founders who had not taken out any capital other than taking very modest salaries. And they've obviously created a lot of value for themselves, and we were very aligned about them having the opportunity to take a little bit of money off the table. Second, for the seed investors, there was another $60 million of capital made available to them to take some money off the table, and many of the seed investors took the opportunity to take that out. And then there was about $60 million of growth capital that has gone into the company. Now, we elected, here's a little bit more on the valuations of the company. We elected not to take out any money in that transaction and achieve any realization for a couple of reasons. One, in making the investment, we can see that General Atlantic has experience and resources to help accelerate the growth of Mabel. And we believe that the probability of success of taking Mabel from a $350 million valuation to a $1 billion valuation is greater than ever. We think the growth rates of Mabel will continue to be very strong, 60, 70, 80% a year. And we've enshrined in the investment alongside the founders, General Atlantic, and our fund, who are now pretty similar investors. There's a key objective for the company to at least double its value in the next 3 years, and then ultimately have a realization event around an IPO in Australia. We believe Mabel would be highly attractive to the ASX. You could list Mabel today. We had investment banks wanting to list Mabel today at valuations that may have been higher than this, right? But we did feel that the company isn't quite ready. It's growing at such a fast pace. We need more talent, more executives to really bed down, all of the platforms that need to be in place in order for Mabel to have that strong, long-term, consistent growth profile.
It must be incredibly flattering both for you as an investor in this company and for the founders to have a company like General Atlantic knock on the door and take equity. I don't believe they've been an investor in Australia before.
No, look, in the very distant past, they have done. I think they had a little stake in Computershare once upon a time, but that was sort of a previous generation. But for them, it is symptomatic. Paul, you sort of said, with them coming to Australia, it's flattering, but I tell you, it's a wake-up call for all of us that global investors in this current, you talked earlier on about the market conditions.
Yep.
People are looking and going further and farther to find these great opportunities, and seeing multi-billion-dollar funds here in Australia is no longer a surprise to me. We have to coexist, compete, and work in a market where there is more competition coming. And that's why it's really important, if you go back to our model, that we're building strong local relationships, because the one thing they can't do, and it's sort of been slowed by COVID, but ultimately our values and our approach to working with Australian founders will always be able to align. American investors, more often than not, if you were to bring them in first time around, there's a degree of nervousness about what are they going to do to my business? How are they going to treat me? What are the terms that they really want? And we work really hard to position ourselves as a friendly Australian investor that's very happy with an ASX listing. We're not going to force you to do something with your business you don't want to do. We are founder supporters.
Yeah, so it's very clear you work on the relationships, David.
Yeah.
Look, I wouldn't mind, thanks for that explanation on Mabel. Can we, look, obviously a topical company for the fund is SiteMinder with the recent IPO.
Yep.
Would you mind explaining the SiteMinder business, David, and what has happened over the last couple of months?
Okay. So SiteMinder, in a nutshell, they are a channel management solution for hotels. So you've got your hotel in Brighton in Melbourne, it might have 40 hotel rooms. And rather than list it on every single site and have to go to Expedia, Booking.com, What If, or whatever the site might be, and then list your hotel inventory through SiteMinder for a couple of $1,000s a year. Once you've loaded up that inventory, you can then manage it across the plethora of hotel booking options. And then you can, in a single click, you can effectively manage the pricing, how the rooms are presented, and it helps you to manage the yield and get the best outcomes for your hotel. Simple sort of solution in many respects, but there's a lot of work goes into executing that. Their business is, their largest market is in Europe. They're a leader in Australia. They're the leader in Europe, and globally they are multiple times bigger than their next biggest competitor. So this is one of the world-leading companies in Australia that, not a brand name that most Australians would know. Most investors might not have heard of the company, but certainly what they do is provide a highly important system to hotels. And the value of that can be seen here, where you look at the number of properties on the platform. During the pandemic, when hotels were being shuttered and staff being sort of laid off, they didn't turn off SiteMinder because they still wanted to have their hotel rooms listed on these different booking sites. So you can see here that the number of hotel rooms fell very marginally, 5 or 6, maybe 7%. And we're pretty optimistic as people have been vaccinated and, we're all longing to go somewhere, that, especially in Europe, they've seen their strongest part of their business start to show good signs of growth. And so hence now was the right time to do the IPO. So if you think about the journey from an IPO point of view, it was always the intention of SiteMinder to list in Australia. When they first took our capital in December 19, we invested alongside Australian Super, Pendal, and BlackRock, some serious sort of global institutional investors, right? And we were able to get alongside them because Ellsteron has a listed equity funds management business as well. Through subsequent rounds of funding, which included in September when we put a bit of additional capital in, and then at the IPO, the Ellsteron funds were some of the largest bidders into the book at the IPO, including JAADE, with our equity funds. And that's really important because companies can see that we're not just, making a trade, looking to exit an IPO, but continuing to follow our money over the journey. We continue to support the business through the raisings. But what you can see is the value of the company continued to improve. Equally, as a private company, the multiples of sort of 7 and 8 times forward sales then turned into 10 times at the IPO, and it's now trading at almost 15 times. Now, that is exactly what we're trying to capture, is that multiple expansion in a business that hasn't had tremendous growth because of the pandemic. It's had incredibly stable growth, but we think looking forward, it now begins to really accelerate. So we think we can now sustain the multiples of 15 times, but you're going to see 30% plus revenue growth from SiteMinder into sort of 23, 24, as they use their capital to really accelerate some of the programs they're running. So we've, as of sort of the last couple of days, we've now started to realize some of the investment. So we had 8.3 million shares at the IPO. We've realized $12.5 million in proceeds at an average price of $7.20. The stock's now traded back as the tech sector sort of rolled off a little bit. It's around about $6.50. And so for us, we're sort of watching it from here at $6.50. We're a bit more neutral, but we're obviously not there to buy any more shares. So it's just a journey now for us to maximize our proceeds. And equally, if we find better private company opportunities, we'll look to realize that capital to redeploy it into new investments too.
I've got to say, Dave, that I find it remarkable that a business of this nature, understanding the pandemic, that there wasn't a significant destruction in the revenue base of the business during that period. And even where you think where we are right now in the COVID environment, that a company like this would be prepared to list in that environment. So I guess what I'm taking out of this is that this is affordable software, essential software for the businesses that use it, and the appetite for investors seeing the growth trajectory going forward is there. Is that a fair assessment?
Well, Paul, you've hit the nail on the head, right? It is critical, and what they're doing. If you're to sort of pull apart the prospectus documentation, what they've been able to do through the pandemic is reduce the friction of how the product works. So that really essential part of what they do has gone from taking clients 40 days to get on board to SiteMinder system. It's now down to, I think, around about 5 days. So like any good technology company, Sankar Narayan, the CEO, who was previously the CFO, COO at Xero, who's got a great level of experience in these types of companies. And Xero's, there's no better story in this part of the world about frictionless technology. He is obsessive about trying to reduce the friction for SiteMinder so it can be an even more material market share of the global hotel market.
Yeah. They're two of the more established investments in the portfolio, David. I wouldn't mind touching on one of the newer investments in JAADE. If we could talk about AsiaPay. I think the focus on payments is something that's really evolved during the COVID environment.
Yep. So AsiaPay is our second payments investment, the first being Tyro, and we had a really fantastic experience with that. And that helped to really educate us about the complexities of the different payment platforms. AsiaPay was a deal that came to us and from a sort of a boutique advisor, and the founders had taken capital out of Twiggy Forrest's family office and sort of seeded the business. And what they're trying to do is they're trying to effectively build a solution that sits on top of the NPP, the new payment platform. Now, the new payment platform is super interesting and something I wasn't familiar with until we started delved into this opportunity. Effectively, through the Reserve Bank, there's been kind of a design created which is now backed by 13 of the biggest banking groups in Australia. And this is designed to effectively create a real-time direct payment platform for Australians. So what that means, and you can see how successful it's been in other markets, but in a practical sense, that's effectively replacing BPay.
Yeah.
So if you're, next time you go and buy your overseas tickets, Paul, for your, on a plane, you can go and you can pay through Qantas, and they charge you a surcharge for using credit cards, right? You can pay through BPay, but then they don't send you a confirmation for 3 days.
Yep.
Because it takes time for that payment to be processed. BPay is a system that was built 30 years ago, and it's not a real-time sort of architecture. What's happening increasingly, and there's a variety of use cases, everything from government organizations to travel to other areas of e-commerce. You can now use real-time payments and basically make a payment on the spot. So what As You Pay effectively does is they use this network, and their piece of software helps the organizations that use it to be able to manage that real-time payment. It's got a low flat fee like BPay, so it might be 60, 70 cents per transaction versus a 2% charge on credit cards, which can be very expensive on your plane tickets. And there's instant reconciliations and payment validations. So PayID, which some of the investors on the call may recognize as a way of making payments, is powered by As You Pay for a growing list of Australian organisations. So, their cornerstone client was here in New South Wales with Services New South Wales. So effectively, when I go and pay for my driver's license and renew it, I can now use PayID to pay, and there's no real. Now, where this gets really interesting is in a world of credit cards, which are more expensive. So not only is the $300 million a year of revenue that comes from BPay sort of, being attacked by As You Pay, but equally there's huge revenues from credit cards that as people become more familiar and the technology and features get built out, As You Pay, who's now got 50 odd clients, is accelerating, adding tens of clients a month at the moment.
And the client base of an As You Pay, is it the large merchants that are appealed to this? Is it the individual? Is it a combination of the two?
It's really interesting. I kind of gravitate to the use cases around us as individuals.
Yep.
Probably one of the ones we had so we do these weekly calls and go through strategy with our portfolio companies in the JAADE team. And where the CEO of As You Pay was really sort of focused on at the moment was a large opportunity with one of the large property management business, so CBRE. Now, if you're CBRE and you've got hundreds, thousands of properties you're managing, and you're making hundreds of thousands of payments around, utilities, receiving rent, they've got teams of 20, 30, 40 people whose jobs are to reconcile payments. So the idea of implementing this, where the technology will complete the reconciliations, means not only are they able to reduce some of the frictional fees, but potentially they can reduce some of the overheads of running their business. So there's a really wide range of use cases. Many that I gravitate to are the more consumer-oriented ones, but the business-to-business ones could actually be more profound.
So I'm just a layperson, David, but how do you value a business like this?
Yeah. So with all of these businesses, there's always a frame of reference on their current amounts of revenue. But the real work that we do is trying to work out where they're going to be in 3 to 5 years' time. So management inevitably gives us an optimistic set of forecasts. We then do due diligence on that. We get comfortable with what we think is an achievable number. We look at how much capital they might need to get there. First thing is we've got to make sure it's a fully funded business plan. And then we look at what it might look like in the eyes of either an IPO, a trade sale. We do DCF valuations. We do about 6 or 7 different valuation techniques, and we triangulate back to kind of a current value and consensus. For the ease of communicating, though, the EV to 1 year forward revenue, whilst revenue multiples, you can't live on revenue alone. You've got to produce profits, right? So revenue multiples are a great way of presenting the relative value of companies. I can assure you, we do a lot of work around future cash generation to see if they, in time, the goal for a company like As You Pay is by no means to generate cash flow. It's about acquiring customers and creating a long journey of lifetime value. So that's where the work and the focus goes. But very much, it's about making sure they can be profitable, sustainable businesses in 3 to 5 years' time.
Terrific. So Azure is it seems an exciting opportunity to me, David, but only a recent investment. You must feel on very good terms with yourself that two existing investors, like we discussed, Mabel and SiteMinder, are doing so well.
Yep.
So it all looks good. But, you know, there is a portfolio of investments there. A question, I guess, without notice, David, but is there anything that is there a company that you've purchased into that perhaps from the point that you've purchased it maybe hasn't quite gone as well as you'd like?
Yeah, it totally happens. You know, it's a fact of life, and you know, we've been very fortunate to be really frank. We've been very fortunate that the technology tailwind means all of our companies have grown. So none of our businesses have gone backwards, right? And probably the area where, you know, there's some work to do is around a company like Prospector. So I'll give you a bit of the backstory, then I'll tell you what we're trying to do to help the business. So Prospector is a data management, data governance platform that's largely used by complex organizations with, you know, the busies of the world, Fortescue Mining, Santos, incredibly large businesses that have very complex equipment and supplies in their business. And it's about validating and ensuring the governance of that data is appropriate for their workforce kind of requirements. Now, what that means in a nutshell is they're selling to extremely big organizations. When they win a contract, they're worth 300, 400, maybe even $1 million per client. What that means is when you're selling to large organizations, things take time. So what we love about Prospector and continue to be very confident in is the quality of the platform and the fact that they don't lose clients once the platform gets in. But when we made the investment about a year ago, we thought the growth rates might be, you know, 80, 90, 100%, right? This is a business that's at a slightly earlier stage of life. And, you know, we've got about $6 million of recurring revenue in the company, but then they do a bunch of software sales, meaning total revenues are just north of 10. We had expected to see that very high growth rate, the 100% type growth rate, and they came in with 50 or 60% growth rate, it looks like, for this year. So, you know, still a good outcome, but probably the balancing act was they'd spent the money based on getting 100% growth in the business. So they probably chewed through more of the capital than what the business plan envisaged. So there's a couple of things that are happening. So there's been some changes to the management team. So we've brought a new CFO in who we think is a real upgrade, has a lot more experience, and will give us a lot more comfort around, you know, how we look at the sales funnel, the conversion rates, and then being able to forecast the revenues and expenses of the business. We've also, I think, made some really significant steps in how the product can then be taken to market and sold. So there's some adaptation. Again, it's about reducing the friction for clients taking it on board. But when we invested in the company, we put $10 million in, and we had an option to put another $5 million in next year. What's going to happen is we're going to put that $5 million in now. And so we're also going to preserve the ability to have an option to put more money in at a later date. But what we want to do is make sure that the company can continue to invest, because they are growing, probably make sure to tighten up on some of the expenses in the business. We still think on a 2, 3, 4-year view that this will work out very well. There's no question it hasn't gone at the pace that, you know, that management wanted. And, you know, I can assure you that our directors are sort of very focused and leaning in to put a bit. So the challenge for us managing a portfolio is SiteMinder doesn't take a lot of time. Things are going incredibly well. What happens amongst our team, Paul, is we end up focusing more on the ones that need a little bit more help. So, you know, whilst Anthony, who sits on the board, and Justin, who's very involved, you know, active with the company on a weekly basis, they don't just turn up to board meetings. It's a weekly, in some cases daily. Sometimes you're sitting in their office working through some work with them, making some introductions. It's just the level of effort, you know, until they can bring the people into the business where we have the confidence, there's a lot more hands-on work required from us.
Yeah, for me, David, that's the defining feature of your fund, the ability for you to be able to assist these businesses. Anyway, what I've got, we're nearly out of time, David, but what I've got out of today is I think the quality of the opportunities that you've been able to identify and invest in are of the highest level. I guess the final question that I've got for you is right now, what does the opportunity set look like? You did mention there's potentially another investment. Is there a good depth of opportunities that you're uncovering?
Yeah. So in terms of the volume of activities, it's strong. Through the back half of this year, as COVID through the middle of the year became a kind of a risk, I think, for a lot of people, businesses, and markets continue to improve because of the flood of capital. There's no question that people were looking more at capital requirements. We saw some massive opportunities, some incredibly big deals. We got 2 investments done during that September quarter, and we've been very. But what we're very clear about, it's great to be able to be having an IPO of SiteMinder at the same time as looking at new opportunities. So this just sort of illustrates the volume of deals that we see. If we get 5 or 10 qualified deals a month, remembering we only want to do 2 or 3 deals a year, happy days. And we, with the amount of money that's gone into early stage companies, there's a growing nursery of prospects out there as we look to next year and beyond. So we don't feel any significant pressure to just spend money for the sake of it when valuations are probably quite high. But I won't go through companies A and B, but I'll talk about company C because we've signed a term sheet with company C. So without going into the details of the business, it's a really interesting situation. So the founder of the business is an Australian entrepreneur who's had 2 successful exits. She's built businesses based out of Australia, but operating in the US market. And so this time around, she's built a technology platform that effectively helps in very large workforce managers. So I think manpowers, large businesses that provide entry-level workers into warehouses, factories, farming, retail, really basic roles. And what happens in the US is because of the complexity around, employment law and taxes, there's these third-party workforce providers that have very administrative intensive businesses that facilitate finding the workers, employing them, and then, the warehouse then pays the workforce manager, who then, keeps a 15% commission, but effectively the rest goes to the worker. Now, these businesses are really old-fashioned Luddite technology businesses. And when you think about how Mabel works as a marketplace, we've seen firsthand how marketplace models can improve the experience for the workers. Now, we're living in a world right now where there's labour shortages that are happening here in Australia, but all through the US. The great resignations that they're talking about in the US media means it's getting harder and harder for companies to find workers. Now, what that means is we're shifting to a world where it's much more of a worker-centric employment model. So what the platform for this company does is it effectively onboards workers through a mobile app, changing a traditional manual process that could be weeks, maybe days if they do it well, down to something that happens in a matter of minutes. Once you get the workers on board, they can then swipe through the jobs that are being presented and pick the work that's suitable for them. If you think back to the old movies where you've got, migrant workers standing on the side of the road waiting to be picked up by a truck, that's exactly what still goes on in many parts of America. And so this platform is about, marketplace technology to simplify how it works. Now, they've got an existing business turning over about $400 million, and they're looking to buy assets in the UK, globally, and the US that would see this business triple in size. And we've signed a term sheet to be the lead investor and to fund that expansion. Now, there's still a lot to go through the acquisition, but we've put a funding proposal in place and there's largely an agreement around it. There is an agreement around it. There's a bit more due diligence to go, but completion on this investment wouldn't be until probably January. But we've earmarked about $40 million of capital, which would make it our largest investment. The founder of the business, having been through it a couple of times before, is very clear about wanting to have an Australian IPO. We've already talked to investment banks. We do think in a 12 to 24 month timeframe, if things went well, this company would be a fantastic fit on the ASX. So, yeah, as you can see, pretty excited about this opportunity.
Very exciting times, David. David, we're out of time. Thank you for today, and thank you for the outstanding results of the fund over the last 2 and a bit years. There they are there. And most importantly, congratulations on the performance of the fund in the last couple of years. We really appreciate the work that you put into this and for participating in today's webinar. Thanks, David.
Always good to talk to you and your clients, Paul. And we obviously enjoy what we do, so it's good fun. It's very
good on you, David. Thank you.
Cheers.
Bye.